Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber reports so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals. In the intermediate term, risk, and the short term is about confidence and sentiment. Today we are going to continue with our three-part series on how the stock market is at least temporarily hiding economic reality and why the powers to be can be counted on to print the money. We will be expanding on the foundational work in part 2, which we have discussed to some degree previously, before moving to the three unfolding stages we see ahead over the next few years. As you are only too well aware, I have been ending these monthly videos with this slide for a very long time now, at least since Trump took power. Before it was the same message, just a different format. What I hope to achieve in this three-part series is answer why this will happen via the facts as opposed to simply an educated opinion. I believe the central bankers of the world are now trapped and will be forced to play out an already scripted series of policy initiatives. I also hope to show in the concluding part 3 why a Minsky melt-up will occur as part of three unfolding stages. We are already in stage 1 as the Minsky melt-up is now underway. What I am sure is surprising to many is it is still likely in its early stages. In part 2, we will cover the following shown here. First, the ETF exposure from the equity markets perspective. Secondly, the lessons from the February 2018 vol shock. Then, the real problem, the bond market, the 800-pound gorilla. And finally, the expected sequence of passive investment liquidity shock, risk parity, ETNs, value at risk, and then cross assets. Since the 2008 financial crisis, the adoption and growth in passive ETF index funds has been truly monumental. The $2.5 trillion, as this chart illustrates, has predominantly come from a shift from actively managed funds such as mutual funds. The big advantages include cost, ability to match chosen indexes easily, overall ease of monitoring, and most importantly of all, rapid entry and exit, a click of a mouse. As you will see, this biggest advantage may be its biggest disadvantage when potentially large numbers of holders simultaneously hit that sell key at the same time. Many will recall from the 2008 crisis, it was this type of simultaneous shift by chief financial officers in moving their corporate cash accounts from money markets to U.S. Treasuries, about $5 trillion in one afternoon, when a money market fund simply broke the buck. That is, it wasn't returning the actual cash at its face value. That sent the Fed chairman and the U.S. Treasury Secretary to a panic, closed-door congressional leadership meeting, subsequently leading to massive actions by the U.S. Federal Reserve and the financial crisis. It is important to recognize that these passive ETF funds are primarily index funds. They mirror an index. As such, they make no decision on the quality nor fundamentals of the component instruments. That is the purview of the active managers. Deterioration is only seen by overall index measures. The trick is to shift to winning indexes, or where the momentum is. It is in many ways a sophisticated game of follow the herd. It works well when markets are trending strongly. It is also something that works well in the later stages of the business cycle. Not surprising that it has caught on so rapidly, more so in the last 4 years than ever. The popularity and success of this approach can't be denied. Global ETF assets could reach $7.6 trillion by the end of 2020, equivalent to a compound average growth rate of approximately 18%, of which 13 to 14% which will come from net inflows. Since the financial crisis, the passive ETF indexes have reached every corner of the global financial markets. The explosion in big tech and the FANGs and NOSH stocks are an indication of this and is why we chose them as one of our SIIs a few years ago. The fund flows have driven these players to unprecedented price levels, completely divorced from historic metrics and not seen or even exceeded since just prior to the implosion of the dot-com bubble. Clearly what this has led to is everyone being on the same side of the boat. The problem with following the pack was most recently seen in February when the vol complex imploded, when the level of participation in building strategies based on shorting the VIX was found to be destabilizing and literally tipped the system. As this chart illustrates, smart investors have already realized this and have begun to shift to stocks that are included in fewer indexes. This is where they are now finding value in that elusive margin of safety that successful investors like Warren Buffett have expounded on for decades. The question is, who is going to buy when everyone hits their sell key at the same time? Who will be left to buy? This problem is as old as the stock market itself. It's called a liquidity. Like a thief in the night, it disappears in a heartbeat. So what did we really learn from the February 2018 vol shock? During that period, we discussed this chart on the vol complex and the distortions and the reflexive reactions that consequentially occurred. I will refer you to the March LONGWave video entitled Black Monday 2, The Repricing of Risk Begins, in both the MetaSII.com and Macro Analytics archives. We showed how the vol complex was only one building block in a range of very interrelated strategies that have become so broadly adopted that the assets under management held within them make them almost investment sectors unto their own. The names of the strategies are shown here. Many were impacted by the vol shock, but with the exception of a couple ETN collapses, they more or less held together as the shock subsided and volatility as measured by the VIX quickly subsided and once again returned to historically low levels. What is important to appreciate is that all these strategies involve the relationship between the stock market and the bond market in some sort of fashion. The reaction strategies, as we saw in February, were dependent on the stock market VIX levels. But that is not at all solely what they are dependent on. Obviously, they're also highly dependent on the volatility of the bond market, a problem that was completely absent in February. But the times, they are a-changing. The VIX equivalent in the bond market is the MOVE index, M-O-V-E index. With bond yields over the last few weeks exploding higher, bond volatility, which is to watching paint dry, has now spiked. This is triggering a raft of reactive shifts. We have been warning for some time that this next shift would be in the bond market, where risk is priced and the mispricing of risk has been a central worry for the global financial markets. The growth in global debt, as everyone is no doubt aware, is unprecedented. What few fully appreciate is that the global corporate debt growth, shown here in red, has been truly staggering as the extended period of QE, quantitative easing, resulted in distortions as a result of corporate debt-funded stock buybacks and debt-funded global supply chain build-out and overcapacity, which I just recently discussed in a video with Charles Hugh Smith. What is more salient in today's discussion is that the growth in flows since the 2008 financial crisis has been in the bond market and not in the equity markets, and the vehicle employed has been newly created bond ETFs and ETNs being exchange-traded notes. Like equity ETFs, the passive index growth has been across all bond types and all sectors globally. Prior to the financial crisis, it was the banks that were the primary market makers of market liquidity. That all changed for various reasons, including Dodd-Frank legislation and the Volcker Rule. The bottom line is that to sell a basket of bonds making up a bondex is significantly more complex and risk exposed than a simple basket of equities. Numerous tools are employed, but all involve complex counterparty risks. This is where the real problem is for passive ETF investment. It is in the bond market. This is highly likely to eventually result in a liquidity squeeze of unprecedented levels that the central bankers may be unable to handle or certainly unable to stabilize in any timely fashion. From risk parity, that is stock bond allocation levels, to exchange traded notes, to value at risk, to cross assets, all are impacted right to their very raison d'etre or core. We are already seeing signals of concern coming from the CTAs, or that is the commodity trading advisors who work in the futures pits. The coming liquidity shock will be like an expanding, oscillating wave, undamped and unstable. This usually takes the market forms as shown here until the powers to be can stabilize it with money printing, policy and accounting rule change, and whatever else is required. In part 3, we'll talk more about what we can expect those initiatives to be. As I often remind our listeners, remember, they will print the money to solve any and all problems until such time as no one will actually take the money or it is of no value to anyone. That day is still long in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers will be forced to react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of unsound money and fiat currencies. I'd like to take a moment as a reminder to not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2018 be an outstanding investment year for you and your family. I sincerely thank you for listening.